If you ever played one of those sports games like football or in Russia, pretty much any sports or just walking down the street, when you get hit in your back and you didn't pay attention, you didn't expect the hit, it's kind of hard to get up. It's so painful, the surprise, the shock, you know how it feels. The same thing will happen to you if you let your portfolio just sit there with all of its growth stocks and Teslas and Palantirs and Bitcoin and let it get shellacked by inflation. Now, we don't want to let that happen to you, and I've been warning you for months that inflation is about to hit. Not hyperinflation, like some idiots think, real inflation, but inflation that will actually make you pay. Now, in this video, we're going to use a company that fits the profile of the type of companies you want to have in your portfolio before this thing hits. And that is exactly why in this video, I'm going to teach you how to bulletproof your portfolio against inflation before it happens, a priori, as a preventative medicine. And speaking of medicine, I think healthcare would be one of the best industries to invest in during inflationary times. There's a lot more. We talked about this on our Patreon and our channel members page. And by the way, if you want to learn more about this, we're doing a whole series, 30 companies in 30 days, which are completely inflation proof that you might want to consider for your portfolio. If you want to sign up, it's $5 a month and you can leave right away after you learn about the 30 companies. I don't care. It's your choice. But in this video, I want to give you a real life example of how to do this. And the best way to teach somebody is not by auditory learning. I can give you all the rules, but it doesn't mean jack shit. If I show you an actual company that fits the profile to perfection, I think that's a way better way to learn. Now, in this video, we're going to take a company called BMY. And as I mentioned earlier, this isn't the only category which will give you that protection. Beyond healthcare, you can look at energy, you can look at infrastructure, you can look at real estate. There's a lot of different opportunities to actually hedge against inflation. The problem is that you got to find something that people don't know about yet, something not as obvious. Obviously, everybody is buying real estate right now like crazy for that reason, so it's already overvalued. The inflation hedges are well known: gold, real estate, assets, so it's obviously going to go shooting up. You got to find the diamond in the rough that people are not paying attention to and hedge your bet there. And it's not called a diamond in the rough for nothing. It's hard to find and it's hard to identify. But in this video, I'm going to teach you how, even though it's not the most intuitive way. Now, check it out. In this video, we're going to go through the entire set of tests. We're going to do a full DCF of this company, BMY, discounted cash flow valuation model. We're going to take a look at the management, their financials, their business model, everything that you need to understand about this company. But the overall subject is definitely inflation protection. And this company definitely fits the bill because I think it's flying under the radar beyond my understanding. I don't understand why people can't see this. But in this video, you'll be the first to find out. So why not? And just a quick word for the new people here. If you have inflation, why does it actually hurt growth stocks and doesn't hurt value stock as much? Well, the simple answer is cash flow. If you have positive cash flow today and a lot of it, you don't have anything in the future. But if you're a growth company and you have a lot of upside coming in the future, and the higher the inflation goes, the higher the interest rate will go, obviously bringing down the value of those future dollars in your growth companies. As simple as that. Now, let's get to it. Okay, now let's take a look at Seeking Alpha because I think it's hands down the best place to look at aggregate financials, performance, and everything. And I'm not affiliated. There's no affiliate link. So first of all, one thing you should pay attention to is the company is valued at $146 billion. Now, there's not a lot of short interest, meaning that smart money is not betting against this company at this price. 0.73%, under 1% of short interest. The other thing you should notice that this is a dividend company. They're paying out dividends. And here you have the forward dividend yield. Now, this is a straight up pharmaceutical company. They make drugs for anything you can imagine, but there is no vaccine play. There's no COVID play. But historically, they've been very consistent in generating positive cash flow every single quarter, as I'm about to show you. As you can see here, their revenue growth year over year was 38%. Now, if you look at the future growth, it's not as good, but it's still very impressive. 22% and 37% for EBITDA. That's actually very impressive. And now look at their profitability. For a pharmaceutical company, I'm impressed. 80% gross profit margin, which is phenomenal. Now, EBITDA margin, 43%. Also extremely impressive. And for those of you who noticed, this is not a glitch. They actually have negative 14.5% net income. Now, how the hell do you have a negative 15% net income when you're bringing 43% EBITDA, 80% gross margin? Well, the answer is that this is a one-time thing because of an acquisition they did, and this is nothing to be worried about. This is not sustainable long-term. This is about to go away. I will show you everything in a second. Don't worry about it. Now, this is the dividend yield, and actually they're expected to give 3.03% next year as far as dividend yield. Not bad at all. 5-year growth rate, 4.6%. So It's a dividend company, not something we are accustomed to see in our portfolio, but in inflationary times, getting a dividend positive company actually makes a lot of sense. And now we're getting to the filet mignon. This thing is phenomenal. Look at the cheapness of this. PE to non-GAAP. Look at this. 10. That's 60% undervalued. EV to sales, 4.22. 47% undervalued. Look at this. EV to EBITDA, 9.85. 53% undervalued. They're undervalued in every single category. Price to sales, 3.3, 60% undervalued. To say that this company is undervalued, it's like saying that Putin is very popular with 50-year-old women in Russia. That's a gross understatement of how much they love Putin. And here's some more interesting facts. It's been trading sideways for the whole year. Look at this. It only did 8% this year. 4% over the past 6 months. Now, over the past 3 months, doing a little bit better, 5.6%, but nothing to write home about. The company has been flat. This is as flat as a Lada tire when it hits just a little bit of rubble, but it means that there's a lot of upside baked into this price, as you just saw with the valuations. And now let's take a look at what other analysts are saying about Bristol Myers. And if you want to get a subscription to TipRanks with a discount, I have a 10% discount code in my description section. Go get it right now. It's definitely the best tool to evaluate other analysts. Now check it out. Now the consensus price is $74 over 65, which is at right now. However, I do want to look at which analysts are saying that. So I only want to have the analysts with the 4 stars and up. Everybody's saying the same thing. The company is undervalued. The only question is by how much. Some guys give it 86, some guys 78, some 66, which is right on the border. That's a hold. But some give it 70, some give it 78. I'm going to tell you my price target in a second. But the consensus is that there's a lot of meat on the bone, which has not been eaten yet. Now, the next part is management. If you've been watching my videos, you know I urge you to take a look at who is the CEO. I don't want to have you give your money to a bozo, because bozos hire bozos and bozos make bozo policies lose you money. Now, we want to make sure we're giving our money to smart executive people who know what the hell they're doing. Let's take a look at Giovanni Caforio. What a great name. So first of all, he's an MD. So he's an actual doctor running a pharmaceutical company, which is a great sign. Now check it out. I always want to look at how long this guy has been with the company, and check it out. He joined in 2000. So he's been an employee of Bristol Myers Squibb for 21 freaking years. That says a lot about the company. As you can see right here, he moved up. He became the COO at some point, and for the past 5 years, he's been the CEO, and for the past 4 years, he's also been the chairman of the board. So this guy is not only in charge, he's really in charge. He doesn't even have a chairman above him. He's definitely driving this bus, and from what I'm seeing based on the financials, which I'm about to show you, he's doing one hell of a job. Okay, now let's take a look at the financials of the company. So first of all, we're seeing huge growth. 2018, 2019, 2020, they went from 21 billion to 41 billion in sales. That's a great sign. 42 billion and a half in 2020 in sales is a phenomenal number, specifically looking at 26.1 the previous year. And for the untrained eye, this seems like bad news. Well, they made 42 million and they lost 49, so they're shit. Well, not exactly. Let me show you why this 49 is completely fake. Now check it out. Cost of goods sold is 11. Which means those are the real actual expenses to make these pharmaceuticals. Now, marketing is also, selling is also, this is all real expenses. Now, at this point, you also have to add R&D, research and development, but that's it. Anything beyond this point is just nonsense gobbledygook, and I'll explain why. These 21 billion are total BS. Not that it's not real. One of them is not a cash flow item, which is amortization. The 9.6 billion is amortization. This is not cash flow. This is a tax benefit. The other one is an acquisition. They bought Myocardia for 11.5 billion, actually more than 11.5 billion, but here it's showing 11.5 billion. So this is an actual expense, but this is an acquisition expense of a one-time nature. They bought a freaking company. So this 11.5 billion has to come off. This also has to come off because this is not cash flow. And what you get here, instead of a 7 billion loss, which actually shows you right now, you get a 14 billion net. And I'm actually going to show you that 14 in another place in this financials where you can actually see that I'm not blowing smoke up your ass. But this is the real number. The company generated 14 billion in actual operating income. If you take away amortization and some acquisition costs, then definitely you have a 7 billion loss. But wait, there's more. Total current assets are 30 billion. Now, goodwill is 20 billion. This is trash. This is nothing. This is meaningless. This is not a cash flow item. You can never get this money back. So when you look at total assets here, 118, it's actually 100 or rather $98 billion in total assets. We have to be mindful of this. Now, check it out. Here's where it's get interesting. Now, short-term liabilities, 2.3, accounts payable, 2.7. So far, so good. Now, here's the thing that I want you to see. 48 billion in debt. That's a lot of debt. 48 billion in total debt, that's a lot. However, the total ratio of 80 billion to 100 billion of actual assets without goodwill is still in the positive, and they do have enough cash flow to actually make it into a 25 net debt, which means that this thing is not as bad as it seems. Plus, I'm going to show you why without the acquisition and without the actual amortization expenses, these guys would have been just fine. Look at this. Net cash provided by operating activities. You remember when I told you 14 billion? Haha, 14 billion. It's right here. I wasn't blowing smoke up your ass. This is the real number. The company generated 14 billion from operating. However, none of this gets recognized by retail investors who don't understand this because they don't know how to dig into this. And that creates a diamond in the rough because people are not looking at this as a 14 billion. They're looking at it as a -7. You have a company that's a 14 billion positive in operating being priced like a 7 negative. That creates a massive opportunity, especially when this company is primed for inflation hedging with its cash flow, with healthcare as an industry. It's a really good opportunity that's not being recognized in the market. And now let's take a look at the DCF, which you all love, which will give us the actual pricing of this company, where it's supposed to be. Currently, it's priced at 146 billion, $65 per share, but I think it's going to be much higher. Let me show you my DCF. Now, I just used the free cash flow that they currently have, and I added 5% annual growth for 5 years. So 5% per year based on 14 billion in cash flow. Now, we used the 10% for the discount rate, and this is what we got. Now, what we got is 75 billion in present values. We applied a 4% long-term growth, and we got 242 billion. Now, that 242 billion is net 25 billion of debt, which means that this was 267, but it comes down to 242 because of the negative debt. And now right here, we have 150 billion, which is based on a 9.5 multiple because it's healthcare. And what we have here right now, these are the actual prices. What we have is $66 for the multiple. Perpetuity gives us 107, which gives us $87 per share right here, which is 33% upside versus the current $65 price. And that's how you get the perfect hack. A company that's currently positioned to protect against inflation because it's cash flow positive, it's in healthcare, it's primed to give you an offset against inflation. And yet, it's still unrecognized by the retail public because its financials are actually a little bit misleading and they don't understand the true value. And also, it still has a lot of growth backed in, 30% regardless of inflation. That is how I want you to look at companies. Try to find these diamonds in the rough. And as I mentioned before, we have a whole plan, 30 companies in 30 days, which will do similar analysis to this, and it's getting posted on our Patreon and the channel member section. It's $5 per month to join. You can join and you can go through the primer with us and leave after a month if you don't see any value. I'd appreciate it if you check it out. You'll also be supporting the channel. Thank you so much for the current channel members and the Patreons. We'll see you guys in the next video.